All right, so today we're going to be talking about the income statement, comprehensive income, and a little bit on the statement of cash flows. We're not going to go a ton into the statement of cash flows, but we're going to at least introduce it today a little more than we did in chapter 2. Like I said before, I'm going to try to keep each of these to around 15 minutes. I know some of my balance sheet ones went a little bit longer, but the goal here is to kind of keep everything in kind of workable chunks. But we'll kind of jump into things and see how far we get here. All right, so let's talk about the income statement first. There are three major sections to the income statement, and I'm going to grab my pen so that I can make sure that I have that. Again, anytime there's a question here, feel free to pause it and then kind of pick it up once you've kind of had a chance to think about it. But the three major sections are income from continuing operations, which is the top section, and then discontinued operations, and then finally below that, earnings per share. And so in this class and on the test, you will need to present all three sections. And so you need to be ready to do that for the test. So let's talk a little bit more about that main section, the larger section on top, which is income from continuing operations. All right, so when we think about income in terms of time, let's kind of think about the balance sheet. So in the balance sheet, we said, okay, it's a point in time. So we said the date was as of December 31st, 2023. And so when we think about the income statement, is it similar in that it has that sort of as of element, or is there sort of a different idea in terms of the timing? And hopefully you figured out that there is a little bit of a difference. If I can get back on my here. And that we do report income over a period of time. As you remember, we kind of accumulate economic activity over a period of time, and then we report the economic activity over that period of time. And so whether it's a month or a quarter or a year, you're sort of accumulating those activities over that period of time. And so, if you do, let's say, monthly reports, your monthly report at the end of January is going to accumulate the income-related economic activity for that month. And then February would be for January and February. And then March would be, 3 months, and then 4 months, until finally, if you had a full year, it'd be 12 months of economic activity all in one income statement. And then at the end of that, you kind of reset and then you restart the next year. So again, rather than a point in time, the income statement is over a period of time. There are some elements that are on the income statement. On the balance sheet, the elements were assets, liabilities, and permanent equity accounts. And so again, anytime we come to these one of these questions, feel free to pause and try to answer it. But there are essentially, 4 elements. We group kind of 2 of them together. But the primary element is revenues, which are inflows of resources from providing goods and services to customers. And then expenses are outflows of resources that you incur while generating revenue. So those 2 things are really kind of matched up together in terms of the economic activity. In other words, what are you doing in providing goods and services? And then what are the costs that you're incurring in order to provide those goods and services? And those are your revenues and expenses. And then there are other economic activities, which are gains and losses, and we kind of group those together. But those are increases or decreases from, basically other transactions where it's not a revenue, it's not an expense, and it doesn't involve owners, but there are gains and losses. So like, gain on a sale of a piece of equipment or something like that would be a common example. All right, let's continue. So we're talking about our continuing operations. Again, these are revenues and gains, expenses and losses that are all part of those things are going to continue on for the company. And then you do have what are called discontinued operations. And those are items that basically, those are done. We're not going to be continuing them into the future. And we'll get into a little more detail on what those things might include. But again, the difference here with your continuance, those ongoing operations, whereas with discontinuous, it will not continue into the future. So we talk about our continuing operations. There are 3 major components. First one is operating income. Second one is non-operating items. And then finally, income tax expense. And so those are 3 items that are separately presented on the income statement as part of our continuing operations. So let's kind of talk about operating income versus our non-operating items. And so, first of all, operating income are going to be revenues, expenses, gains and losses. There are not a lot of gains and losses, admittedly, but mostly revenues and expenses that are directly related to the primary revenue generating activities of the company. And so those are the core operations, the repeating activities that go period after period after period, and it's sort of that's directly involved with the revenue generating process of the company. And again, I tried to highlight those important words, direct and primary revenue generating activities. Example would be, of course, sales revenue, whether you sell goods or products. Cost of goods sold, the cost of those items that you sold, along with operating expenses that may relate to those primary activities, like salaries, supplies, insurance, rent, those kinds of things. Even depreciation would be included in this. And so when we kind of think about breaking that down a little bit more, another thing we need to talk about is what is gross profit, and then maybe how is this different than operating income. Again, gross profit is defined as revenues minus cost of goods sold. And if you've taken a management accounting class, cost of goods sold is fairly tightly defined. And I always think about it as, if you think about making something, I always think sort of behind the factory door. So what are those items, those costs that we incur that happen behind the factory door? So, if you think about making cars as an example, so you have, the labor, you have the materials, you have the overhead, all related to the production of cars. And so all that stuff that's behind the factory door, those would be things that we call cost of goods sold. And it would even include some depreciation in terms of depreciating those behind the factory door items. It could be equipment, building, things like that. You do actually at times allocate depreciation expense into cost of goods sold, and for those items that are directly involved in producing the good or item. Operating income then is sort of that next step, still those direct costs, but they're really not behind the factory door. They're more, sort of front office types of things. So it could be salaries of your senior executives. It could be depreciation of office equipment or the headquarters building. It could be, rent for the headquarters building. It could be supplies used at the headquarters building. And so, again, this is still direct expenses, but really not the factory door type things. And so I will say that in practice, distinguishing between something that's part of cost of goods sold and that's part of operating expenses, there's a lot of judgment there, and firms do it a lot of different ways. I've seen some companies that try to allocate as much as they can to cost of goods sold, and I've seen others that allocate as little as possible to cost of goods sold. And so there's a lot of judgment, and really it's meant for decision making, of course. And so hopefully you exercise judgment and you apply that judgment consistently, so that you can compare, company A to company B to company C. But in practice, as you jump into this, you'll start to find that some companies do it very different than others. And so you do have to exercise a lot of judgment. So then you do have your non-operating items or your non-operating income. So these are, again, revenues, expenses, gains and losses, but, it's not those primary revenue generating activities. It's rather those indirect activities like gains on sale, interest expense, those kinds of things. So then the last major section is called income tax expense. It's always going to be presented separately. So your income tax expense does need to be specified on the income statement because it is so important in financial reporting. So make sure you understand that needs to be separately, distinctly reported. If you do have discontinued operations, you do need to make sure that you separately identify the income tax expense related to ongoing activities or continuing operations, and the income tax expense related to our discontinued operations. They do need to be separated. And that separation is called intra-period tax allocation. Intra-period tax allocation. Okay, so let's talk about the two primary formats that you might see with an income statement. One is called a single step income statement, where basically, all your revenues are listed first, and then all the expenses are listed second. And then you still have your income tax expense being reported separately, but there's really no distinction in revenues and expenses, just all your revenues, gains, all your expenses and losses, income tax expense, and we're done. Whereas the second one is called a multiple step income statement, where you're going to get these intermediate subtotals. And those intermediate subtotals are gross profit, operating income, income before taxes, and then net income. And so there are these distinct steps, again, multiple steps in the income statement. And so, in this class, you're going to be responsible for producing a multiple step income statement, just so we're clear. I assumed you probably knew that, but you need to make sure you're able to do that. I will say, when you look at income statements or financial performance, whatever, profit and loss, whatever you want to call it, I'll tell you, there's a lot of variation in the way that things are presented, much more variation than with the balance sheet. And so just be aware of that. However you present it, net income is whatever it is, but the way that it's broken down varies a lot depending on the company, the industry, the level of detail that they want to present. And so just be aware of that. Now, obviously, in this class, I'm going to show you a very specific format, and you're going to need to follow that format. It's a very comprehensive format, but in practice, understand there is lots of variation. What's general format? If we think about single step versus multiple step, which one do you think is more useful? The one that kind of lumps everything together, or the one that kind of breaks it down? Hopefully this one's obvious. The multiple step income statement is going to be the most important. And so I think this is a good place to stop for this lecture. I know we didn't quite go 15 minutes, but we'll stop here and then we'll pick up with the next one.